Business operation can be conducted in a number of different legal forms, including sole proprietorship, partnership, trust and estate, S corporation, regular corporation or C corporation, limited liability company. As a sole proprietorship is not a separate taxable entity. Rather, its operations are reported as part of the sole proprietor individual income tax return. The owner of the sole proprietorship report all business income and expense of the proprietorship on Schedule C of Form 1040, with the net profits or loss from the proprietorship included in the taxable income of the individual proprietor. The proprietor report all of the net profit from the business regardless of any amount actually withdrawn during the year. Income and expenses of the proprietorship retain their character when reported by the proprietor. For example, ordinary income of the proprietorship is treated as ordinary income when reported by the proprietor, and capital gain is treated as capital gain. Beginning in 2018, a deduction for qualified business income or under Section 199A is available for sole proprietors. In general, this deduction is 20% of the proprietorship net income and is claimed on the Proprietor Form 1040 in determining taxable income. Partnerships are not subject to the federal income tax. However, a partnership is required to file Form 1065, which report the result of the partnership activity. Business income and expense items are aggregated in computing the ordinary business income or loss of the partnership on Form 1065. Any remaining income and expense items are reported separately to the partner. Partnerships are discussed in detail in other chapter. The partnership ordinary business income or loss and the separately reported items are allocated to the partner according to the partner profit and loss sharing agreement. Each partner receives a Schedule K1 that reports this information. Each partner then reports this item on his or her own tax return. In addition, individual partner can claim a deduction for qualified business income or to the extent available on his or her Form 1040. Corporations are governed by schedule by subchapter C or subchapter S of the Internal Revenue Code. Those governed by subchapter C are referred to as C corporation or regular corporation. Corporations governed by subchapter S are referred to as S corporation. S corporation, which generally do not pay federal income tax, are similar to partnership in that ordinary business income laws flow through the shareholder to be reported on the shareholder separate return. Also, like partnership, certain items flow through from the S corporation to the shareholder and retain their separate character when reported on the shareholder return. The S corporation ordinary business income loss and the separately reported items are allocated to the shareholder according to their stock ownership interests. S corporations are discussed in detail in other chapters. Unlike proprietorship, partnership, and S corporation, C corporations are subject to an entity-level federal income tax. This results in what is known as double taxation. A C corporation report its income and expense on Form 1120 and then compute tax on the taxable income using a flat 21% rate. For example, for the taxable year beginning after 2017, when a corporation distributes its income, the corporation shareholder report dividend income on their own tax return. Further, no corporate deduction is allowed for the individual pay. As a result, income that has already been taxed at the corporate level is also taxed at the shareholder level. Taxation of dividend. Double taxation stems in part from the fact that individual distributions are not deductible by a C corporation. To avoid this, closely held corporation shareholders try to convert dividend distribution into tax-deductible expense. A common way to do this is to increase compensation to shareholder employee. However, the IRS scrutinizes compensation and other economic transactions, for example, loan, lease, and sale, between shareholder and closely held corporation to ensure that payments are reasonable in amount. For individual shareholders, some of the double taxation effect is alleviated because dividends generally are taxed at lower tax rate. Qualified dividend income is taxed at a rate of 15% or 20% for high income taxpayer or 0% for lower income taxpayer. This rate also applies to long-term capital gain. Comparison of corporation and other forms of doing business. When comparing C corporation to other business form, there are a number of factors to consider, including tax rate, character of business income, business losses, employment taxes, and state taxes. Tax rate, as noted earlier, a flat rate of 21% applying to corporation taxable income for taxable year beginning after 2017. Historically, however, a graduated corporate tax for corporation range from 15% to 39%. And once corporation have taxable income of 18 million 333,333 or more, is paid a flat 35% tax rate. The margin rate for individual range from 10% to 37%. In many cases, taxes will be greater in the corporation form. However, corporate form of doing business present tax saving opportunity when the applicable corporate marginal rate is lower than the applicable individual margin rate. The flat 21% corporate rate that applied beginning in 2018 could significantly increase this tax saving opportunity. Any attempt to take advantage of the difference between corporate and individual marginal tax rate also must consider the effect of double taxation. When the preferential rate for dividend income is considered, however, tax saving opportunity still exists. Collector of business income. Unlike other forms of business, the tax attribute income and expense item of the C corporation do not pass through the corporation entity to the shareholder. As a result, if a business is expected to generate tax favored income, it may be better to choose a different business form. Pass-through or losses. C corporation losses are treated differently than losses of other business forms. A loss incurred by the proprietorship may be deductible by the owner because all income and expense items are reported by the proprietor. Partnership and S corporation losses are passed through the entity and may be deductible by the partner or S corporation shareholder. C corporation losses, however, are retained at the corporate level. If losses are anticipated, it may be better to choose a business form other than a C corporation. Employment taxes. The net income of a proprietorship is subject to the self-employment tax as 15.5%, as are some partnership allocation of income to partner. Alternatively, wage paid to shareholder employee of a corporation are subject to payroll tax. The combination of corporation employee payroll tax burden must be compared with the self-employment tax in the proprietorship and partnership business form. This analysis should include the benefit of the deduction available to the corporation for payroll tax pay, as well as the deduction available to an individual for one half of the self-employment tax pay. And now we move on to the state tax. At the entity level, state corporate income taxes and or franchise taxes apply to corporation. Some state impose a franchise tax on all business form if a business will be operating in multiple states. State taxes become more important. At the owner level, the income of sole proprietorship as corporation and partnership is subject to state individual income taxation. The tax attribute of the various form of business entity are compared in concept summary. Non-tax consideration. Non-tax consideration may override tax consideration and leave owner to conclude that a business should be operated as a corporation. Here are some of the more important non-tax considerations. Sole proprietor and general partner is in partnership face the danger of unlimited liability. That is, business creditor can file claim against the assets of the business and the personal assets of the proprietor or general partner. The state corporate law protects the personal assets of shareholder. The corporate form of business provides a vehicle for raising capital through widespread stock ownership. Most major businesses in the United States are operated as corporations. Shares of stock in corporation are freely transferable. A partner's sale of his or her partnership interest must be approved by the other partner. A corporation continues to exist even when the shareholder dies, death, or withdrawal of partner. on the other hand, may terminate the existing partnership and cause financial difficulty that result in dissolution of the entity. Discontinuity of life is a distinct advantage of the corporate form. Corporation has centralized management. All management responsibility is assigned to a board of directors who appoint officer to carry out the corporation business. Partnership have decentralized management in which every partner has the right to participate in the organization business decision. Limited partnership, third, may have centralized management. Lastly, we learn about the limited liability company. The limited liability company, or LLC, is a business form that brings some corporation form advantage into a flow-through entity. All 50 states and the District of Columbia have passed laws that allow LLC, and thousands of companies have chosen LLC status. As with a corporation operating as an LLC allows its owner to avoid unlimited liability exposure, which is a primary non-tax consideration in choosing business form. The tax advantage of LLC is that qualifying business may be treated as proprietorship or partnership for tax purposes, thereby avoiding the problem of double taxation associated with regular corporation. Entity classification. It can an organization that is not a corporation under state law still be treated as one for federal income tax purpose? The tax law defines a corporation as including association, joint stock company, and insurance company. Unfortunately, the court contained no definition of what constitutes an association, and the issue became the subject to frequent litigation. It was finally determined that an entity would be treated as a corporation if it had a majority of characteristics common to corporation, like continuity of life, centralized management, liability limitation, free transferability of interest. This criteria did not resolve all of the problems that continue to rise over corporate classification, and when the state allowed the creation of LLC and the IRS was dilute with inquiry regarding its tax status. The court does not identify LLC as the business form, and state LLC law differ. So the question was how this entity would be treated under federal tax law. To ask this problem, the check in the tax the box regulation were issued by the Treasury Department. The regulation enabled taxpayers to choose the tax status of the business entity without regard to its corporate characteristic. This rule simplified tax administration considerably and eliminated much of the litigation related to association status. Under the check the box regulation, an unincorporated entity with more than one owner is, by default, classified as a partnership. An unincorporated entity with only one owner is, by default, classified as a disregarded entity. A disregarded entity is treated as a sole proprietorship if it is owned by an individual or as a branch or a division of a corporation owner. If the entity wants to use its default status, it simply file the appropriate tax return. If it wants to use a different status or change its status, it does so by checking a box on Form 8832. Thus, an LLC can choose to be taxed as a C corporation, and if is otherwise qualified, even elect as corporation status. Although an LLC does not typically pay federal income tax, LLC are required to report and pay employment and excise taxes. And these are all about different company and type of company or thing like that. And thank you so much. Hope my reading is help you in your business. Thank you.